This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to the TF Metals Report, weekly podcast highlights for the last week of February 2021. It was a very volatile week, and it looks like next week will be volatile as well. You might want to check out tfmetalsreport.com and consider a subscription if you want to stay on top of everything in these volatile times. We began the week this week all the way back on February 22nd. It seems like a month ago with everything that has taken place. The week ended with a sharp move in the bond market, but on Monday, February 22nd, we were already focusing upon that at TF Metals. And so this cash has built up a treasury, which is why inflation hasn't yet picked up. But this is why people now are expecting inflation to pick up. Why the commodity index is going crazy. Because the Treasury is going to start spending down this cash balance. You can see historically where it's been below $500 billion. And how's the Treasury going to spend this down? They're going to spend it on all these transfer payment programs and the stimulus checks and everything else that's going to go on in the next couple of months. But there's going to be more than that. There's going to be even more money raised, right? You know about this $1.9 trillion that's coming, and the talk last week about another $3 trillion in stimulus, because remember how Powell is begging for stuff to monetize? Which means the Treasury is going to be marketing all of this short-term debt again to raise, to keep the cash going. And when they do, if the Fed buys it all, again, they're going to crowd out the competition. So it's a double-edged thing that is will force yield curve control. Even Mother alluded to that today. And again, maybe it's not even called that to begin with. But it's hard to see once you read this article and listen back to what I've been telling you about my discussion with DDB last week. It's hard to see how the Fed doesn't shift their buying away from the short-term stuff, the bills with less than 1 year maturity and the 2-year note, out the curve, 7 years, 10 years, 20 years, even 30. They may not want to, but they may have to. And then you start driving long-term yields down. It's the same impact that yield curve control would have at the same time as inflation's picking up. And here we are, gold soaring again. This is the basis of our macro cast this year, and everything is still in place to see that happen. So please read that article from Reuters. In fact, I would encourage you to print it off. Make sure you understand what they're talking about here, because this is how all these pieces fit together. On Tuesday, February 23rd, one of the things we were discussing was the daily chart of gold. It looked like there was some upside, but by the end of the week, we knew there wasn't. But back on Tuesday, it was a big topic of discussion. All right, finally, just to update, really kind of the same charts we've been following. There really aren't significant updates, but it is what it is. I mean, this will get exciting again in gold at some point, but for now, we have to wait for this to turn and then break out. Now, maybe it has. Like I said, you can always spot bottoms with hindsight. Maybe there's a double bottom here at about 1770. The action yesterday, very encouraging to get back above that red line, which again was resistance from the middle of August to the middle of December, and then offered support. And it really does continue to offer support, even though we dangled down below it last week a couple times. As I mentioned yesterday, once we fell below there, you can look. In January, bounced and rode and went back up to the purple line. And then in early February, got up, even tried to get through the purple line and fell all the way down below the red and bounced up back up to the purple and then down and below the red. And now we're bouncing again. So again, I don't see why, especially if I can get some improvement in the bond market or a further sell-off in the dollar, I don't see why gold at this point isn't going back to the purple line. Where would that mean tomorrow? 1840? Yeah, that's probably asking a lot for tomorrow, but maybe by Friday we could be at 1830 or 35. That wouldn't surprise me at all. Now, what would that accomplish? Nothing. I mean, we'd still just be in this down channel pinned below that purple bull flag boundary. But you never know what could happen at that point. Get above there, all of a sudden you're dabbling with the 50-day, and then we're trading above 1860 again and 1880, and everybody starts getting excited. That's only $75 from here, which is about 4%. That's not asking a lot. On Wednesday, it was time to take another look at silver, now that option expiration day was behind us, but yet the contract going off the board was still pending. We also took a look at the SILJ, which is an ETF primarily composed of silver mining companies. And now silver on the daily chart. Uptrend off of a clear, perfect double bottom. Uptrend now has been going almost for 90 days. Looking solid to me. Finishing right at 28 on the Globex. Be very interested to see what happens these next couple of days. The SILJ, again, if silver is looking so solid and moving through 28, why would the SILJ not be doing well? 3 really solid candles this week. Really solid. Tried to sell off intraday yesterday, completely recovered. Closed with a little green hammer thingy, now extending that today. Filling that gap completely, but also moving higher from February the 1st. These levels, these closes up here from early January that kind of coincide with the intraday highs in August. Okay? These levels up here, 1750, are the next things to watch. And man, we start moving to 18. I mean, all this starts to point to 20. We've talked about that quite a bit before. On Thursday, February 25th, however, things really started to go haywire with almost record moves in the U.S. bond market, with bonds selling off and interest rates spiking. This had a terrible impact on gold, silver, and the mining shares. So we thought we'd take a look at the chart of the GDX and just kind of see what might be a critical level to hold as the month draws to a close. I want to show you the GDX. This is a monthly chart of the GDX. A month obviously comes to an end tomorrow. And this is ugly, right? 1, 2, 3, barely a green candle back in November, and then just ugly since the beginning of the year. But in a sense, we are still flagging on a bull here, right? You got a bull, and you can call this a handle or a flag. The key level here is where I've drawn this red line. I've often referred to it as 32. That's really not quite right. If you look at it on the monthly chart, this line is closer to 3150. That peak back there in 2016 is actually 3170. All right, but it's somewhere in here. It's not quite 32. It's about 3150. What we don't want to see is a complete washout tomorrow. That closes us down on the month somewhere below 3150. That could happen. It wouldn't be the end of the world, but I would rather not see that happen. But somewhere down here between 3150 and 32 should be, at least is the way I do things, the low. Obviously, we're not there yet. Or maybe we were there today. But we're still within a pretty classic breakout, flag, handle, whatever formation here. And on Friday, February 26th, we end the trading week and the trading month, and it is getting ugly out there. With COMEX gold, COMEX silver, and all of the commodities getting smashed sharply lower. Yesterday's debacle in the bond market, frankly, a continuation of the trend in the bond market, is starting to really upset all markets globally, and we're beginning to see shades of last March. Now, whether that will continue next week, we'll have to see. But at some point, unless the Federal Reserve begins to hint at yield curve control and a desire to keep long rates down, there may be more downside ahead. Now that gold has violated its 50-week moving average for the first time since this bull run began more than 2 years ago, it certainly appears there's more downside to come. Last spring, we went through a 100-day period in a range between 1680 and 1780, with 1680 offering pretty staunch support. That appears to be where we're headed now, and that might be the next opportunity we have to buy a dip. But for now, as we head into the weekend, things look pretty dicey, not just in the precious metals, but across all markets, including the U.S. stock market. And it looks like we will have a very volatile week ahead. Please join us at TF Metals Report for daily analysis of all of this. Intraday analysis as well. Got a post every morning and a podcast every afternoon. There is no other side of the internet that will keep you more up to date with each trading day. Again, tfmetalsreport.com. We hope you enjoy these free podcasts, and we look forward to a very interesting week next. Have a great weekend, everybody.